Most traders use indicators the wrong way. They rely on signals without understanding what smart money is doing behind the scenes. In this video, I'll show you 3 powerful indicators and how to combine them with smart money concepts like liquidity sweeps, key levels, and top-down analysis to find high-probability trade setups. Let's get started. The first trading indicator we'll cover is the Fibonacci retracement tool. Take a look at this chart example. The market is in an uptrend, indicated by a strong impulsive move to the upside, followed by a pullback. Begin by drawing the Fibonacci retracement from the start of the impulsive move to its highest point. As price retraces, pay close attention to the area between the 50% and 61.8% Fibonacci levels, commonly known as the golden zone. This zone often acts as a key area where the pullback may come to an end, and the next bullish move can begin. If you prefer an aggressive entry, you can place a limit order within the golden zone without waiting for additional confirmation. However, keep in mind that this approach involves greater risk, although it also has the potential to deliver larger rewards. Take a look at this chart example. The market is clearly in a downtrend, characterized by a strong impulsive move to the downside, followed by a pullback. To draw your Fibonacci retracement, place it from the beginning of the impulsive move down to its lowest point. As price retraces, focus on the area between the 50% and 61.8% Fibonacci levels, commonly known as the golden zone. This zone often marks the end of the pullback and the beginning of a new bearish move. If you prefer a more aggressive entry, you can place a limit order within the golden zone without waiting for additional confirmation. However, keep in mind that this approach comes with greater risk, although it also offers the potential for larger rewards. Entering trades based solely on the area between the 50% and 61.8% Fibonacci levels can sometimes work, but I do not recommend using this approach on its own. Let me show you an example to explain why. In this uptrend, we see a strong impulsive move to the upside, followed by a retracement. We draw the Fibonacci retracement from the beginning of the move to its highest point and place our entry within the area between the 50% and 61.8% levels, commonly known as the golden zone. However, instead of reversing higher, the market continues to move lower, breaking through the golden zone and eventually hitting our stop loss. As a result, the trade ends in a loss. So, how can you improve the odds that the 50% or 61.8% Fibonacci levels will hold? This is where I want to introduce a powerful technique I use called the TLL method. Let's break down what the TLL method stands for. TLL stands for Trend, Level, and Liquidity Sweep Signal. For a Fibonacci retracement level to have a higher probability of holding,